Welcome to the Daily Update Podcast, where I'll go over the action in the market for Monday, June 2nd, and we'll see how things look for Tuesday, June 3rd. Going over what happened on Monday, the S&P 500 kicked off the week with a familiar pattern. A lower open, much like Friday, as prices briefly dipped below the daily pivot at 58.93, finding support at the S1 level of 58.63. From there was a solid rebound, with the S&P closing near its intraday high, up 0.41%. While volume was below average, the broader trend remains positive across short, intermediate, and long-term horizons, with prices holding above key moving averages. Megacaps were the driving force behind Monday's advance, though internal market weakness is persisting, pointing to a lack of broad participation. The buy the dip mentality remains strong, fueled by confidence and a touch of FOMO, the fear of missing out. But as we know, sentiment can shift quickly. Right now, the market is stuck in a choppy, non-trending range, waiting for either consolidation to fuel an upward move or signs of weakness to spark a pullback. Looking at economic and policy factors, trade was a major talking point. The U.S. announced a doubling of steel and aluminum tariffs to 50% effective Wednesday, raising concerns about inflation and supply chain disruptions. China responded, accusing the U.S. of violating a preliminary trade agreement, where last week the U.S. accused China of doing the same. However, nerves did calm after President Trump announced planned talks with President Xi, and open-ended trade negotiation offers added to the positive sentiment. The ISM manufacturing report came in at 48.5, slightly below the expected 49 and signaling contraction, but better than feared. This contributed to a late-day market bounce. Meanwhile, the 10-year Treasury yield ticked up to 4.46%, where it had been at 4.41% after Friday, still below the 4.5% threshold, but this had minimal impact on stocks. Stocks did rebound about when interest rates topped out and started to decline. On the technical front, the VIX closed at 18.36, which is below the critical level of 20. Short-term momentum is positive according to the Williams percent R, but other indicators such as stochastics, CCI indicators, and the slope oscillator are sending mixed signals, with some showing negative divergences. The bullish percent index for the NASDAQ 100 declined but remains extreme positive, while the McClellan oscillator and summation indexes reflect internal weakness. The advanced decline line was flat, but there were more new highs than new lows. However, the 10-day advanced decline oscillator is declining, which is unusual for an up day. Switching over to sector performance, energy led the pack on Monday, followed by tech, communication, and discretionary all closing positive. Industrials were the only sector that finished negative. The major indexes showed resilience, with the S&P 500 and NASDAQ 100 rebounding. The S&P got above 5,900 as the NASDAQ climbed back above 19,000. Small caps were mixed, with the S&P 600 down 0.41%, while the Russell 2000 small cap index was up 0.33%. Economic data provided some context for Monday's moves. Construction spending fell 0.4% month over month, missing expectations of a 0.1% gain, with private construction down 0.7% and public construction up 0.4%. Imports and exports are rising, possibly as businesses front-run anticipated tariff impacts. Currently, the trend is that growth is outperforming value, particularly in the large caps, while mid and small cap growth to value ratios are mixed, though still positive. Emerging markets are underperforming developed markets, with the U.S. trailing Europe. Hedge funds continued buying tech stocks for the third straight week, though retail investors are driving the so-called Magnificent Seven stocks, including Nvidia, Google, and Apple. Looking at valuations, the S&P 500's PE ratio stands at a lofty 21, with the NASDAQ 100 even higher, signaling expensive markets. Small caps on the S&P 600 and equal-weighted index are more reasonably priced, while the Russell 2000 small cap index appears overvalued. Historical data offers some optimism after a May gain of over 5%, just like we saw, markets typically see strong returns 1 month and 1 year out. However, we're in the third year of a bull market, which historically tends to be weaker, though loosening financial conditions suggest more liquidity. Looking ahead to Tuesday, June 3rd, the economic calendar features the JOLTS job openings data, with more reports on deck later in the week, including ISM services on Wednesday, jobless claims, productivity, and unit labor costs on Thursday, and the all-important employment report on Friday. Geopolitical risks remain a concern, with potential escalations in the Middle East as well as Russia and Ukraine, alongside ongoing tariff and trade war worries. Technically, the market is positive but not trending, with mixed oscillator signals and internal weakness. That said, positive seasonality for early June supports a bullish bias, though conviction appears lacking. In conclusion, the market is navigating a choppy, non-trending phase with a positive tilt, largely driven by mega-cap stocks. Internal weakness and mixed technical signals call for caution, but dip buying sentiment and favorable seasonality provide near-term stability. Thank you very much, and I will talk to you in the next podcast.